Here's the take from Jim Bianco of Bianco Research. He writes the following: by the Fed stepping in and adding functionality and making everybody rush back in, they're just buying what you're targeting because you're targeting it, not because they think that the measures are telling them that things are getting better. I want to bring in Jim Bianco right now, the founder of Bianco Research. Jim, fantastic to catch up with you, sir. You reflect on Goodhart's law. When a measure becomes a target, it ceases to be a good measure. What on earth do you do when most of the market becomes a target for policymakers?
Well, you do what small retail has been doing. You recognize that the market has been disconnected or divorced from the underlying economics, that the Federal Reserve is there to make sure that the market goes up because they've turned the argument around. You'll hear this today, that higher markets create GDP and create jobs. And you understand that the Fed has structured the market so that you always win. And that's why we're seeing a giant rush of small retail investors and everybody else into the market. And furthermore, when you go into the market, you go to the riskiest end of the market. So you buy bankrupt companies, you buy beaten down airlines, you buy cruise ships, you buy retailers, because they will benefit the most from a support system where everything is targeted and the markets will always go up.
Jim, I think we've got to talk about consequences then. The market purists quite clearly will hate this, but this is not capitalism. I want to be really clear about that. This is not capitalism. Professor Rajan was on the programme with Tom, myself and Lisa Abramowitz a little bit earlier, and he talked about enabling transformation. If you do these kinds of things, you prevent transformation. They are the underpinnings of capitalism. And I just wonder if we really thought through, Jim, the consequences of that.
No, I don't think we have thought through it. I think Professor Rajan is right that we are not allowing the markets. Look, you know, Joseph Schumpeter's creative destruction. We need to let markets adjust, bend, fold. We need to let economies adjust, bend, fold. We don't do that right now. 2 weeks ago, Chairman Powell came out and was almost gleeful to say, look, markets would become dysfunctional, maybe because markets had rethought a lot of these companies that were asking for credit. And we forced them to give companies that maybe markets didn't think needed to survive money to survive. So we're not allowing them to, the functions of capitalism to efficiently allocate capital. And over the long term, this is going to be a problem. But no one's thinking about the long term right now. All everybody's thinking about is the restart of the economy and getting things going better, making sure that next week is better than this week. And as long as that trend is in place, and it has been, we consider this to be a win.
So, Jim, what are the long-term consequences? What is it? Excess capacity, lower inflation? What are the longer-term consequences of all of this?
Well, I think one is a further disconnect of markets from the economy. As long as people keep pouring into the market saying that the job of the Fed is to make sure that I win, that's not going to stop. What you're seeing with small retail is not going to stop because it's Wednesday or Thursday. It's going to keep going until it gets worse. The other problem is malinvestment. As you continue to allow inefficient companies to survive, you heighten the chance for inflation. I actually think on the back end of this, you're going to see an inflation problem that will manifest itself in 21 or 22, and that might also bring about higher term interest rates going up as well too. So I think that there's a lot that they have to think through right now. But you'll notice with the questions they'll probably be asked this afternoon will all be about the next 2 months. We won't really be thinking about the next 2 or 5 years when we start contemplating this policy.
Jim, what do you think the counterfactual is?
The counterfactual is that the market is 2008. The Fed did some version of this in 2008, and they won. The markets recovered. The economies recovered. There was no inflation. But the consequence of that was we never got rid of QE. We talked about it going away for 11 years, and it never really went away. 10 years later, in 2018, we tried to get rid of it. The markets threw a fit. It came back in 2019. So I do think, though, the counterfactual will be, don't worry, this will work. The economy will go up, jobs will be created, everything will recover. And I think the backside of that is okay, then this policy of buying ETFs, buying corporate bonds, maybe yield curve control, there's no reason for it to stop. If you do it and you win and everybody wins, why would you ever stop it then? And that's what we saw with QE from 10 years ago.
We've got to talk about investor process then as well. Jim, as I said to Bob Miller of BlackRock a little bit earlier, we can talk for a long time about what the Fed should or should not do. I know you're pragmatic. We've got to reflect on what they are doing and what it actually means for investment. If you have a price-insensitive buyer in your asset class, and that goes beyond sovereigns in the front end of the curve, it goes throughout the whole of fixed income and into credit. If you now have a price-insensitive buyer in your asset class, what do old school metrics like valuations mean in a world like this?
They don't mean a whole lot at that point. And not only do you have a price-insensitive buyer, but you also have the Federal Reserve, that price-insensitive buyer, promising you that they have a lot more tools in their toolbox, promising you that they have near unlimited capacity to continue to go. So you wind up seeing valuations to be almost not matter. That's why what very rarely gets discussed with what's happening with the stock market, the standard measures of valuation are showing that it's very overvalued right now. But this is not a typical year. This is not a typical cycle. So we're inventing new ones, just making them up. You know, the 2-year or 3-year forward earnings PE ratio is an example to try and justify the current level of the market. And so we still come back to that fundamental problem here, is that if we're not allowing capital to flow away from bad ideas and towards good ideas, and we're impeding that process with a price-insensitive buyer, then we should expect that the traditional metrics and the traditional ways that we invest won't work as well either. And you've seen a lot of professional managers talk about eating humble pie in the last couple of days because they've completely missed that.
So what's the pain trade here, Jim? Tighter spreads, higher equity markets?
It depends on who we're talking about. I think that the pain trade for professional investors is definitely going to be higher prices because they're still skeptical and having a hard time embracing this. I think the pain trade for small retail investors is going to be lower prices because they're all in thinking that this is a giant casino, and they've been winning at that strategy for the last couple of months. So it's going to be hard to say that there's one overall pain trade in the market right now. It depends on which category you're talking about.
Jim, let's take you to the news conference. Let's say we can get you in that virtual news conference with Chairman Powell a little bit later. I'm sure a lot of my audience would quite enjoy that. What would your question be for Mr. Powell today?
Is about the functioning of capitalism. How does markets take money away from bad ideas and give it to good ideas? How do we allow the economy to evolve if every time the markets decide that there's ideas that don't deserve money, you step up and start buying ETFs and start buying corporate bonds and then brag that all of these companies got financing and they continue to exist? How does an economy adapt and change in that environment? I'd like to hear him tell me how that will work. I suspect he won't have a very good answer other than say that it's about preserving those jobs immediately right now. And that's a laudable goal, but it comes with a long-term consequence.